Hi, this is Jeffrey Cohen, and I'm here to speak to you today about corporate finance. Um, I think I'm going to call this Corporate Finance 101, everything you wanted to know about corporate finance but was afraid to ask. And so, just as a review, I'll talk about what we accomplished in the last call. This is actually part two. And actually, we've written this thing up, and so I'm going to be posting it somewhere. But so we started by talking about the basics of portfolio optimization, or what I need to know about Corporate Finance 101. Because I realize as we're talking about optimizing stock portfolios, some of the basic questions are things like, what's a share of stock? What's an asset? Why not bonds? Why not currencies? Why not commodities? Why not real estate? And then even simple things. I mean, what exactly are you doing, Jeff? Like, does this even make sense? What does it mean that a portfolio would be efficient? And just how do people make money on stocks? So what we did is we talked through things like, what's a share of stock? What's a share buyback? Are there different types or classes of stock? So I'm going to review a little bit what we talked about last time, but not in detail, but just some key points. And so this is a key point right here. What are the different types of shares of stock? And so what we decided is we're going to optimize common stock. Common stock is the stock that's offered that is consistent. Each share has one vote. Each share is like one percentage point, one weight of the company's ownership. Whereas preferred stock many times looks like a bond. It has an interest rate. It pays a dividend that's guaranteed. It is ahead of a common stock in terms of liquidation privileges. And so we don't want to cover those. And in fact, I went and I took all those out of our list of stocks. We also take out ETFs. An ETF is an exchange-traded fund. So if you think of a mutual fund, you think of a group of stocks pulled together, invested for the benefit of the shareholders. An ETF, and those have a net asset value published at maybe 4 p.m. Eastern every day, and they trade. They're not really meant to trade during the day. They trade like once. They're meant to trade like less frequently. An ETF trades like a stock every second, every minute, every day. They're marked to market every day, and so we look at common stocks. How do people buy, hold, and sell stocks and bonds? I didn't talk a lot about this, but what I do say is people make money owning a stock by either receiving a dividend, which is payable by the company, and there's other distributions like a capital distribution from a company. And so an example I keep using is AT&T stock, which is ticker symbol T, will pay 52 cents next quarter. So if you bought it for $30, you're going to get 52 cents next quarter. They're saying 52 cents potentially every quarter, but you can't count on that. So count on 52 cents next quarter, or maybe $2.08 if you want to look into the future for a year. So that's not bad. If you spend $30, you get $2 every year for the rest of your life. You're getting $20. And if you assume a net present value with a 10% interest rate, $2 a year is $20. So you're buying AT&T for $10. That's great. But in general, people buy it so that it goes up in value, or they sell it so it goes down in value before they buy it back. The other thing you can do is you can lend out the stock to somebody else who wants to sell it, who doesn't own it, and will give it back to you when you need it, and they give you like an interest rate. The other question that I had was, can I buy shares directly from a company or another investor? And the reality is no. You buy your shares 99% of the time from a stock market or a stock exchange or a financial exchange. There's one exception, which is if you own stock, let's say AT&T, you could do a dividend reinvestment plan where maybe there's even a little bit of a discount, but there's definitely no commission. And that 52 cents can be used to buy shares of stock. So if you, in theory, had 60 shares of stock, 60 times 52 cents is a little more than $30. You'd get one share of stock every quarter. That's great. You don't have to pay a commission on that. So I'm going to move very quickly now. So let's go to what we, this is important. How do I find out the current price of a share of stock? This is very important. Because what happens is if you click on, oh look, I moved, Yahoo Finance. By the way, I love Yahoo Finance. They give us all the data that we use. They don't pay us or anything, but take a look. I look, market route, tech stocks are down. I look up, I see the NASDAQ. Maybe I click on the NASDAQ. And I want to see how the exchange is doing. I see all these prices on the side as well. And the reality is my system's a little bit slow. It takes a moment. Actually, system's really slow. Thank you, Comcast. I'm not going to be able to show you what I want to show you, so I'm going to do something different here. Okay, great. So I look at NASDAQ and I see that it's down $2.05, and it's as of 10:14 a.m. But then I look up at the clock and it's 10:16 Eastern. So 2 minutes behind. The market could have moved a lot in 2 minutes. And so what you see is actually the stock market opened low and has been climbing. So we may have already climbed a lot in the 2 minutes. And if I, again, use my favorite stock here for example purposes for teaching. It's not my favorite stock to invest. Favorite stock to teach is AT&T. So I go into AT&T and I say, all right, so Jeff, you keep talking about $30 a share. What's $29.04? Okay. Bid-ask spread is 29.10 cents to 29.11 cents. Obviously, this data is wrong. It's obsolete. It's out of date because the market's already moved down 6 to 7 cents from where we are. So either the bid-ask spread is wrong, or the stock today is wrong, or the options are wrong. My guess is that the options also aren't updated. So if you really want current to the second stock prices, you need to pay for those. And those are called market data services. Companies like Thomson Reuters put them together, or sometimes straight from the exchange. So I'm going to keep up the options for AT&T because we're going to talk about that later on in our discussion. So again, we're going to do a real discussion here about corporate finance. So let's dig in right here. So, how does an outsider or a potential investor value the equity in a corporation? So, and hang on, before I answer, I want to make sure that I have open the YouTube page where I could see comments, right? I have it open. So let's see. Good morning, everyone. Please ask questions here. So hopefully people will actually ask questions. It makes it a lot more fun when I do a live stream if people ask questions. So, all right. So an outsider or potential investor values the equity in a corporation. The first thing you have to do is figure out what is the money that I expect that corporation to generate, the cash. So if I look at AT&T and I think they have a certain number of subscribers, they have different businesses, so I have to value each of those businesses. And I can do it what we call big animal pictures. I could look at the return I expect from the phone company, from DirecTV, from their entertainment assets. And maybe I look at the best information I have. So, all right, So AT&T is going to generate $10 billion of cash free a year. Then I have to look at what that's worth. So net present value, 10% interest rate, just add a zero in the end. So they generate $10 billion in cash, that's worth $100 billion. Let's say they generate $20 billion in cash. Times 10, 10% discount rate, because there's not a lot of risk for AT&T. They're probably going to stay in business. So now it's $200 billion. But then I have to subtract off all the debt in the company. Debt gets paid first. So $200 billion. Let's take a look at what the debt is. Where do I find that? I think I find that in financials. I'm waiting for it to load. So I think the debt of AT&T is pretty high, right? So if I take a look and just, I look at the balance sheet, because debt is always on the balance sheet. By the way, so is cash flow. So if we want to, we can assume last year's cash flow is going to roll forward, and that's fine too. But I usually don't like to do that. So if I look at total debt, it's $185 million. That's a lot of debt. If I'm going to generate $200 billion worth of cash flow, and I've already got $185 billion worth of debt, then truthfully, I got $15 billion of market cap to play with. And my guess is there's a lot more in AT&T. So let's see where we're off. What was our cash flow last year? So hopefully what this shows you, so let's keep going, but there's a lesson here that actually Jim Cramer taught me a long time ago. He taught me that Comcast shouldn't have slowdowns in the network. But if I look at operating cash flow, they actually generated $44 billion, but they invested almost $20 billion in the business, and they had to pay for financing. So at the end of the day, they didn't generate that much cash at all. It's pretty sad. So if I look at 44 and I subtract 20, let's say they're generating $24 billion moving forward. That's $240 billion. You subtract off the debt, $185 billion. Now we're at, let's just say even say $100 billion. So the stock in the company, because they've got some buildings and they got some stuff they can sell things, right? There's actually a big AT&T high-rise in Chicago that I'll just assume that they own for a minute. And now I try to look at the market cap of AT&T. Now let's say it should be worth about $50 billion. How are we doing? Is it $50 billion? My guess is it's a lot higher. So there's something in there about AT&T that people just believe is going to be worth more. They believe in growth. They believe in goodwill. Market cap is $200 billion. That's a lot of billions. I got to tell you, there's a lot of belief going on with AT&T. And so that is how you would value a stock. And so you have to like make believe that AT&T is going to generate a lot more cash. They're going to get really good at what they do. They're not going to generate $20 billion, $25 billion. They're going to generate $35 billion, $40 billion, $50 billion in cash a year to justify, let's say, $200 billion in market cap, $200 billion in debt, and a bunch of risk. So that's probably why AT&T is falling. So each stock might take an hour a week to really think about if you're going to do fundamental analysis of a company. So now let's talk about options. Okay, so stock options. We all hear about it. Very few of us actually trade stock options because you need like special regulatory approval. So what is a call option? A call option, simply put, is a timed permission to buy shares of stock at a certain price. So there's call options in December of 2020. Pretty much they can expire every 3 months. So December, January, February, March, April, May, June, July, August, September. And so there's call options that are going to expire in September, so that adds a lot of risk anyway to the market. And so everyone's betting on this. They're like, I'm going to put down maybe $1 and I'm going to bet on the chance that AT&T goes up so that when I buy it, let's say I buy a call option at $33 or $34, that when that call expires or before then, the stock price is going to go up and I'm going to make a profit. So if the option is at $34 and the stock goes to $34.10, that means if I executed the call option, I make 10 cents a share. If I paid less than 10 cents for that call option, I made a profit. Let's take a look at those call options on AT&T. It's always interesting, right? Because I've traded options before. And by the way, in about a month, I made enough to buy a new car. I did. I actually bought a car with the profit I made from one set of options I bought. But there's other times where I bought options and they went to zero and they expired with no value. And so there's no guarantee here. So let's take a look. September 11 is when the call option for AT&T expires. You can also buy them September 18, September 25. So AT&T options look like they're every week for the next 2 months, and then it's monthly. November 20, December 18, January. You can buy call options all the way out to January 2022. That's a long term, or a leap. It's a long term. But let's say I just want to look. I'm a this year kind of guy. Let's look at 2020, December 2020. And I'm looking at call options on AT&T stock. I'll make it even bigger so you can see it better. By the way, this is the best reason not to trade stocks at home. It takes forever when the network is slow. And by then the market's already moved. You don't know what's going on. So if I want to buy a $34 call option, so by December, the stock's going to go to 34 from 29. That's up $5. That's a lot. It's going to cost me 23 cents a share. Actually, let me double check on what the categories are. Last price, bid, ask. So actually, I could bid between 17 and 20 cents a share for that. So let's say I don't want to take that much risk. Let's say I want to just say the stock's going to go to $30 a share. What's it at now? 29? Yeah, it's at 29.6. So if I want to give myself the chance to December, $30, it's going to cost me between 95 and 99 cents for the stock to go up $1. So if the stock goes up roughly $2, I make a profit. That's great because I invest $1. If the stock goes up $2, I make money. That's very different than spending $30 to buy, or $29.06 to buy one share of stock, and then wait, and then collect my 52 cents a quarter. I can make a leverage bet, and if I really feel good about AT&T and I'm willing to think it's going to go up to $32 a share, that's only going to cost me between 41 and 45 cents a share to make that bet. And in fact, 10,609 call options are in the market right now being traded. So there's a lot of people making that bet. 16 of those options, of those call option contracts, have been traded today already. What's a put option? A put option is the opposite. It's the ability to sell that share or that set of shares on a certain date for a certain price. So if I believe that AT&T is going, to a call option is to buy, a put option is to sell. So if I think AT&T is going to drop, I would buy and own put options. And that way, I have the right to make that bet. And so I can also look at put options in my options. So those are calls. Hang on. And those are my puts. So Just refreshing the page, get the new prices in. So if I want the ability to sell, that's fine. We're going to do September 11. If I think AT&T is going to drop and I want to sell it at $29, that's going to cost me between 24 and 25 cents a share. By the way, the price of that option has gone up 9 cents or 56%. So if I just held those options, and you can see a lot of them traded, 1,277 contracts traded today out of a total of 3,581 in circulation, you made a ton of money. So you would have held it 9 cents less. You would have held it at 15 to 16 cents, and now it's worth 25. You could sell it at the end of the day. You made all this money. You made 50% of your money today. That's great. So this is what I'm talking about, where options fluctuate, especially near market. So why would somebody invest with an option instead of the underlying share of stock? Well, the reason is that your underlying share of stock costs $30, and really you hold it. You hold it for a week, a month. I guess you could hold it for a minute or a day, but you have to put $30 down to hold it. You would invest in an option if you wanted to hedge a large holding. So let's say you really liked AT&T, and you put all your life savings into it. All of it. 100%. You're all in on AT&T. You love the phone company. But what if it drops a lot? Well, you can hedge that risk. You could actually cover your stock with either buying or selling options that you hope would expire harmless, out of the money, zero. And so you take the premium, you sell the option, you cover yourself, you hedge your bet. And then if the stock market does crash and you do, theoretically all the AT&T stock loses its value, you've got some options that you would at least make back most of the money that you would have lost. So you can cover yourself. So people like options because they can cover a risk. Think of it as a company. If you're an airline and your biggest risk is the price of jet fuel, it's a pretty big risk. I want to say it's like 10 or 12% of the operating cost of a company. You could buy options on the price of jet fuel so you can lock in a price where you can make profit. And sure, it costs you money to buy or sell those options, but that's okay because that keeps you in business. And so there's leverage and there's risk mitigation. So why are options overseen more closely by regulators? Why do I have to fill out if I or you want to buy or sell options? Why do you need to fill out separate forms and get separate regulatory approval from the Securities and Exchange Commission? That's weird. You're just a regular person. You're just going to do some stocks, Well, it's because you can make very dangerous bets with options. So imagine if you sold what's called a naked option. So we talked about covered options, covered calls, covered puts. That means you have the stock and you own it. You haven't lent it out. So if the stock market goes up or down, the worst thing that could happen is they take your stocks. You've covered your loss. Sure, you might lose the $1 a share or $2 a share, but you're not gonna lose the whole value. I mean, imagine if you sold a put option on AT&T that you will allow somebody else, right? You basically will sell that stock at, I'm sorry, I'm saying it the wrong way. No, you'll allow somebody else to sell and you'll buy that stock at $30 a share. And the stock goes to a penny. That means you have to pay $30 for a stock that's worth 1 penny. You'll probably lose all your money and you'll be out. That's a naked option. And it's really dangerous to use naked options even for a second because you never know what's going to happen with the market. You could say to someone, you're allowed to buy AT&T stock at 30, naked call. Next thing you know, AT&T goes to $200. There's an acquisition or something crazy happens. They strike oil inside the AT&T office buildings, right? Or free gold or Bitcoin are found. oh my God, it just went from 30 to 60 or 80 or 100, and you had 10,000 shares of stock, and now you guaranteed that someone can buy it from you at 30, but you have to go to the market and buy it at 200. It's naked. Don't get naked. And that's why options are more closely overseen. For people, for companies, for investors that are hedging their bets, options are a very safe, economical alternative to provide risk mitigation and insurance for your portfolio. I love options. Let's talk about different styles of investing. So our Chicago Quantum Net Score is used for a buy and hold strategy. But Jeff, what do you mean by that? By the way, I'm going to go into my chat and say hello again. Please chat or ask questions. Glad to have you listening. All right. So buy and hold strategy for stocks is when you buy, let's say, for a month or a year or until some event. I'm buying stocks to pay for my children's college fund or to buy a car or to invest in for a house. So you buy the stock. You are buying individual shares usually or mutual funds. You are hoping to enjoy a dividend yield. You want to enjoy capital appreciation where the stocks go up. If the stocks go down, you might even buy more and do this thing called dollar cost averaging. So if you buy AT&T at $29.06 and it drops to $28, you celebrate. Because now you have $28 next month and you're $29 next month and you get more than one share. And if AT&T were to drop to $10 a share, you do a dance in the street. Because for every $30 you had to invest, you used to buy one share, now you're getting 3 shares. And since you don't need the money until you need to buy that house, you're hoping that the value of AT&T goes back or goes up from where you bought it from. You're thinking $200 billion is a bargain for AT&T. I love that price. So my independent valuation, my fundamental valuation of AT&T is $29 a share, so I'm going to buy it. And there are people, a lot of people, that look at stocks, look at companies, and they do valuations, and they decide. So fundamental investing, strategic investing. Now, what is day trading? Day trading is different. Day trading looks at the pattern of stocks. When you day trade, you're in and out within a day. You hate the idea of going to sleep at night with an open position because you're not watching, right? Imagine if you're watching every second. You might even, when you go to lunch, cash out your trades because you're looking for movement. So maybe you buy whenever the stock hits a nickel at a nickel increment, you're up. And then you sell when it gets to 10 cents. You buy at 5, you sell at 10. And you look for that volatility, that up and down throughout the day. And you don't want to hold it for long term. You want to be in the morning and you want to be out at night. So that's day trading. We do not support day trading at this point. There's lots of great algorithms. I went to a PhD program that used to train day traders, Illinois Institute of Technology. So what is computer-based, algorithmic, or high-frequency trading? Well, so there are different models that you can teach a computer to look for. And one of them is reversion to the mean. So if I have 10 stocks in an industry, let's say oil exploration, and the price of oil goes up 1%, then you would have a calculation that says, well, for every barrel of oil that those companies produce, when the oil goes up by 1%, the value of my production goes up by 1%. So the stock should go up by a certain portion of 1%. If they make a lot of oil, if they produce a lot of oil, and they maybe even have leveraged contracts for other people's oil production, maybe their stock goes up more than 1%. Maybe just a little less than 1%. So you would have that mapped in your computer, and then may be possible that the price of oil goes up, and some stocks go up and some are slow. So reversion to the mean, they all should go up about the same amount. or some high flyers and some low flyers. You could also look for arbitrage, where some stocks, let's say there's a company that just owns 1 billion gallons or 100 million barrels of oil. If oil goes up 1%, you would expect that stock to go up by the 100 million barrels times, the price of a barrel of oil. Algorithmic trading, you could be looking at different patterns in the stock, and you would program a computer to go in and out of stocks to make trades. And arbitrage investing, which I just kind of jumped into, is you're looking for the difference between two values. So if, let's say, AT&T stock trades on multiple stock exchanges and the price is different by, let's say, more than your cost of trading, let's say it's off by 2 cents across different exchanges, you'd buy and sell to capture that 2 cents, especially if your cost of trading is only 1 cent, because then it's like feels like a risk-free arbitrage on 1 cent. You can arbitrage across exchanges, you can arbitrage across asset classes. So how do I build a stock portfolio? And what is an efficient stock portfolio? This is the core to understanding our economic modeling. And so this is it. You've come to the right place. So it all starts with selecting shares of stock to have in your portfolio. We just assume that you will invest an equal amount of cash in each stock. So if you have 10 stocks, you have 10% in each stock. The other way to do it is to do a market capitalization weighted portfolio. And then if you're going to invest in 10 stocks, you add up the equity capitalization, or in some cases, equity plus debt capitalization. And then you just do a weighted average for each share. For us, we like it's easier, 10% if it's 10 stocks. First thing you have to do is you have to build an expectation of future stock risks and returns. So what does that mean? That means the capital asset pricing model says that you cannot predict the movement of a single share of stock or a company. You can't. If I knew what AT&T would be worth tomorrow, I'd be a billionaire. If I could consistently predict the future, I'm a billionaire, I'm a trillionaire. I might as well just predict who's going to win the Super Bowl, the World Series, the Stanley Cup, and the Olympics, right? Can't do it. But what you can do is you can look at a stock and you can figure out when the market goes up, does the stock go up? When the market goes down, does the stock go down? Do we follow the market? Beta. Beta is based on the correlation of the stock against the overall market over a period of time. Typically, when you go to Yahoo Finance, you can calculate a beta. You see their beta, and it might be over 3 years or over 5 years using a monthly data set. And so we're going to see what AT&T's beta is as soon as the system loads. Beta of AT&T is 0.64, 5 years monthly. So that means over the last 5 years, if the stock market went up 1%, AT&T went up 0.64. If the stock market dropped 1%, AT&T dropped 64% of 1%, or 0.64%. So what that really means is AT&T has a low beta, it doesn't move as much. So if I could make a prediction or a forecast of next year's stock market gains, then AT&T is going to move relatively slowly compared to that stock. Compared to all the stocks. If I were to look at, let's say, Tesla, by the way, they make great cars. I would like to have a Tesla. Maybe if we can make some money with our stock picking application, I promise to buy a really nice electric vehicle, renewable energy. But wow, is this slow? Tesla. I'm not going to answer that call. If it's a client, please call back. I'm sorry. Doesn't matter. So beta could be as high as 2, 2.5. And so that would mean that a stock goes up a lot. So we build an expectation of future stock returns based on a prediction of the rise in the market and an estimate of how much each individual stock will move compared to that market. For stock risks, we can look at the variance, the movement of the returns of each stock over time. And again, if I were to show you a chart for Tesla, oh, there it is, beta is 1.64. So if the stock market goes up 1%, Tesla you'd expect to move 1.64. So take a look. Tesla's moving like crazy, 14% movement. It's crashing as we watch it, 14%. When I look at AT&T, it's less than 1%. Just Tesla will tend to move more each day if the market moves. And so, but if we look at a plot of Tesla, it's going to take forever, so I'm not going to wait. What will happen is you can look at the movement of Tesla every day, and you can compare that movement to the movement of every other stock, and you could build a covariance matrix or the core data set that you would use to predict how much variance or volatility you would see in Tesla. By the way, it is really distracting when you look at a stock and it is down 14% in one day. I mean, 14% is what I would expect to earn in a year holding stocks. And to see a stock move that much in a day just drives me completely crazy. So, just a personal point. So, what's the expected return of a stock? Well, expected return of a stock is the beta of that stock. And this is when I might have to actually show you the academic article that we wrote. So I'll do that. Beta of a stock times, here we go. So let's show you the chart. This is a paper we published in, it was July. So expected return of a stock is the weight of that stock, 10% in AT&T, 10% in Tesla, times the beta of each of those stocks, 1.64 for Tesla, 0.64 for AT&T, times your expectation of the risk premium from holding stocks. So what do I expect to earn above the risk-free market? So let's say we just said 14%, let's call it 14%. And I expect to be able to earn in a bank account or in treasuries, 1% risk-free. So 14 minus 1 is 13%, and then I add back the 1%. So 10% times 0.64 times 13%, that covers AT&T, plus 10% times 1.64 times 13%, and that's for Tesla. And I would add that up for all 10 stocks. And then I add back my 1%. So I'm probably looking at a return of, 14%. If my beta's average 1, stock market return, I expect to earn 14%. So that's my return. And I do that for each stock. What's the risk of a stock? Well, the risk of a stock is a standard deviation of the returns of that stock. The standard deviation of the return is actually the weight, 10% of each of my 10 stocks. And you multiply that using matrix multiplication times the covariance of that stock against all the other 10 stocks. Because I could look at how much they move together. So if you look at the water, sometimes you see a school of fish. And what happens is the school of fish, they swim together. Especially if you drop a little pebble or a leaf in the water, they all move together. Well, that's really scary because if I'm investing for college or to buy a house and the market goes up and it just keeps going up, that's great. Every stock just moves up. But if the stock market goes down that day, or today as an example, then all the stocks go down. Well, I don't like that. I want some of the stocks to go up, some of the stocks to go down, some of the stocks to stay the same so that they cancel each other out a bit. Look, I might not make as much money every day, but I lose less. And then I multiply that again with the matrix. So I do the transpose of the matrix on either side, and that gives me a symmetric matrix. It's just really helpful. And I have to take the square root, because standard deviation is the square root of variance. So once I do that, now I have the return of a portfolio, and now I have the standard deviation of a portfolio. By the way, now you can build your own Chicago Quantum Net Score and build your own system. But realistically, I can build that for every possible portfolio that I'd ever want to run. It's terrific. Now, what's diversification in a portfolio? Now, there's charts that I can use and all that, but let me just explain it this way. If I have one stock, so if I woke up in the morning and I bought Tesla, wow, did I make money? Look at that. I bought it at $50, and I have $350. I love it. Tesla went up $300 a share, and I made a fortune. But if I bought it yesterday, or if I bought it at $442 and now it's at $350, I'm crying. So diversification means, how do I reduce my exposure to the risk of Tesla? Well, the other way is buy AT&T. If I look at AT&T over a year, it has a totally different shape. It was pretty flat up high, and then the market crashed. Now it's pretty flat low. And so Tesla has a different shape. It's going up because they make great cars, and people believe. And there's AT&T, which is kind of moving with the economy, right? It's the economy, stupid. And so if I put 100 of those stocks together, then I'm going to have a beta of roughly 1. I'm going to move with the market, and I've diversified all of my company's specific risk out. And in fact, we see this. If you hold about 30 shares of stock, it's really hard to get a Chicago Quantum Net Score or a great portfolio that really stands out from the crowd. There's no standing out from the crowd with 30 stocks. And 50, 60 stocks, there's almost no difference. Whatever stocks you want to hold, just hold them. Doesn't matter. So diversification takes away your ability to have market or stock-specific returns in your portfolio. You just got rid of them. I mean, if you have 1% of 100 stocks, 1% of your money in 100 stocks, you're basically betting on the market. Now, an efficient portfolio, and this is important, our definition of an efficient portfolio is either the return of the stocks divided by the standard deviation, or the risk of the stock. So for every 1 unit of risk, I want the most return. It's one way to calculate it. And then we came up with a new way, which is the Chicago Quantum Net Score. This is really new. No one else has done this. So you take the variance of your returns on those stocks. So I got 10 stocks. I expect my variance to be 1%. And I subtract my expectation of my return of those 10 stocks raised to a power. And I actually tweeted today that I might have to change my alpha on the power because the stock market moved and it's specific. So this says if I'm balancing out my variance to my expectation of return, I might want to balance those to 0, or I might want to maximize the negativity or have the most expected return to offset the variance that I expect moving forward. That's an efficient portfolio. And that's based on looking at every single portfolio, every single combination out there. That's why we needed a quantum computer, is because we're looking at 10 to the power of 19 portfolios to look at. And I want to know in a minute what I'm supposed to do. So, an efficient portfolio maximizes the expectation of return for every unit of risk. And you can do it with subtraction, you can do it with a ratio. I gotta be honest with you, most people I know, they don't know how to do this. People in the biz, like in the financial asset management business, they talk Sharpe ratios and things like that all day long, but Most individual investors just say, is it a good stock? I mean, my friends will say, Jeff, you're going to pick the best stock for me? No. I'm not going to do a cash flow analysis with a quantum computer. That's a spreadsheet. You could just use an Intel Pentium processor and do great. My Macintosh will do a great job, right? We can type all the numbers in and we can guess. An efficient portfolio is based on the movement, the patterns behind the scenes of every stock for a year, every day, and then move it forward, take it forward. That's how you calculate an efficient portfolio. So it's what you don't see when you look at the stock market pages or you look at the news. An efficient portfolio is not buying the best stocks. It's buying stocks that move together to reduce your risk of investing. I jokingly call it my widows and orphans work because a widow and an orphan, right, they need the money. Let's be honest, right? This is tough times. And if I can help them invest in an efficient portfolio so they don't even have to take one iota of risk more than they have to, it's perfect. They can earn their dividends, they can earn their capital gains, and not have any extra risk. Then I've done God's work. Section 6 of our write-up is the tax implications of investing in stocks. Now, I am not an attorney, so I cannot give you tax advice, but I can give you just a layman's approach. So a capital gain of a stock is the difference between the price you paid for it and all the costs associated and how much I get when I sold it. So if I buy AT&T stock at, let's see, what would it trade at this year? So over the course of a year, it traded as low as 26 and as high as 39. So if I bought my AT&T stock at 35 and I sold it at 30, I made $5 a share. And that's net of any commissions or costs that I had. So let's say I made $5 a share. A capital gain is I made $5 a share. I had 100 shares, so I made $500. And now I have to pay tax on that in the year that I did this. Now, if I held the stocks for more than a year, that's terrific. Because more than a year means I pay a lower level of capital gains. If I held the stocks for less than a year, that's a short-term capital gain, the rate is higher. Capital gains are less than the rate that I pay tax on capital gains is lower than the rate that I pay on a dividend. So companies, if they want to help save me a few bucks, they would rather help their stock go up than pay me dividends. What's a dividend? A dividend is the amount of money that the company pays to me as a dividend or as a regular payment of earnings. AT&T pays a dividend of 52 cents next quarter. So I pay tax on dividends in the year that I receive them, less, and there's no direct cost. I just pay it. It's regular income. It's dividend income, and I pay it at my income tax rate. So for us, that could be based on how much I earn. It could be 39% federal, another 5% for the state of Illinois. Plus, there's a new thing for people who earn a lot of money called the net investment income tax, which helps pay for the Affordable Care Act. And that's another 3.8% on top of any investment. So I'm paying my 39% plus my 5% plus my 3.8%. And this may even trigger an alternative minimum tax rate. Oh my God, I'm paying 45% of my dividends. My capital gains, maybe I'm paying 30% or 25%. So net, you'd rather earn capital gains than dividends, but most people, they like a dividend check every month or every quarter. So my brother, who's really good at the stock market, Seth Cohen, he told me a long time ago, Jeff, if you're going to invest in stocks, as long as you can, don't sell them. Buy a stock, buy a company you believe in, and hold it. Because then what happens is those capital gains, you don't have to pay tax on those capital gains until you sell them. And so let's say you were to earn money every year. And so the first year you're investing $1,000. The next year you're investing another $1,000. Well, you're investing it for your retirement, let's say. So sell it when you retire. Don't be buying and selling all the time. Then you don't pay those capital gains. Makes great sense. Okay, now I'm going to go into section 7, which is beliefs. What do people believe? And what do they debate about the stock market? So the first thing they believe is financial markets are efficient and they immediately reflect information perfectly in a stock price. So the reason Tesla is moving and is down 13.4% because some news came out. Right now, there's news. And everyone who might want to buy and sell the stock knows all that news. So let's take a look. What news did Tesla have? I don't see much news. I see that the stock market fell. Oh, GM made a production partnership. GM's buying a stake in Nikola. Maybe that made Tesla drop 14%. Maybe. Tesla did not join the S&P 500. Maybe that made it drop. That's 2 years ago. Okay, that feels a little more important. So maybe the fact that Tesla's not in the S&P 500 and that GM took a stake in a Nikola electric truck company made Tesla drop 13.92%. Okay. That is this concept of reflecting information perfectly in stock prices. But other people believe that it takes time. Maybe people are at work right now. Maybe they drove to work. Maybe they're sleeping, right? They checked their phone at the end of the night. They find out Tesla, oh my God, didn't make the S&P. Now it's a day later. So you still might have some residual buying and selling a day later, 3 days later. The second thing is that financial markets are equal to both large and small investors. It's a fair bet. And I say no way. On this one, I hold a very strong belief. If I'm sitting here at home and Comcast Business Service wants to be slow, and I'm trading stocks at the speed of my click, 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 I like AT&T. Let's take a look at the chart. Let's wait 3 seconds to see the chart. Let's take a look at the financials. Let's take a look. Now I'm going to buy and sell the stock. So I'm going to go to I buy stocks. There it is. Buy and sell stocks with Schwab. By the way, I just picked the first one. We do not have any relationship with any asset management company. I go and open my account. I go buy some stocks. I click a few clicks. I own 100 shares. Honestly, the big players probably have a direct network connection at a very high speed right into the network where they're going to trade the stocks. They don't have mouse clicks. They're telling computers when to buy and when to sell. And they're moving at the speed of a computer program. I'm moving at the speed of a mouse click. So my trade goes slowly. And by the way, if Charles Schwab decides that they want to trade my stock directly, they might. They might also offload those orders to another market participant. Let's say a Goldman Sachs, Morgan Stanley, Merrill Lynch, and they might trade the stock. So now I gave the order to Charles Schwab. They give the order to Goldman Sachs. Goldman Sachs calls the market maker and says, I have 10,000 orders I want to settle out. Those orders get made. By then, the market might have moved. Oh my God, the stock's at $29.19. I was hoping I was going to buy it at $29.15. I just lost 4 cents. It's not fair. Plus, information and assets. So we've spent a year building an investment optimizer. You don't have that. Unless you know about our company and you pay $50, you don't have that. If you're only investing $1,000, you might not want to spend $50. The big investors spend millions on IT, on applications, on analysts, and they have a good way to predict what's going to happen in the next second or minute. And they have tools and techniques. The other is that past performance is not an indicator of future performance. This is absolutely true. You cannot look at the price of Tesla over a year and say, oh, it went from $49 a share to $358.80. So it must go up another $300 next year. You can't look at it that way. What's the past is the past. The past is history. The future's a mystery. The present is a gift. And so focus on what you know right now. Focus on what new information comes out. Don't try to look at the past and predict the future, because it's not the case. You can't do it. It doesn't work. So past performance, in fact, is not an indicator of future performance. So stocks usually fall in price when the economy is poor or uncertain. Well, that would make sense. Starting at the very beginning of our discussion, stocks should be fundamentally valued based on the cash flow that they produce. So AT&T should go up and down based on the amount of money people have to spend on phone service or internet access or entertainment assets. Rental car company should be based on how many cars people rent. Airline, how many miles people fly. Right? Amazon, how much people buy online. I love Dollar Tree, right? Dollar Tree goes up and down based on back to school, and people need money to buy things. But maybe Dollar Tree is a giffen good where people actually spend more money at Dollar Tree when the economy's bad. There are some such things as companies that do better when the market drops. Pawn shops. Pawn shops probably do a lot better when the market drops. The company that makes Mountain Dew. Who's that? PepsiCo. I bet PepsiCo does better when people have more money to spend on pop. And so, but it takes time. And stocks are actually valued, according to some people, on a future expectation. How much cash next year, for the next 10 years, let's say, discounted with a cash flow? And so it's not just how the economy is doing today, but it's the expectation of how the economy is going to do and how that will affect certain stocks in the future. Finally, stocks exhibit reversion to the mean over time. I exactly believe this. This is one of my core fundamental beliefs, that markets will revert to the mean. Things fall back to the average. In Japan, there was a saying I was taught when I first started consulting to Japanese companies, which was, the nail that sticks up gets hammered down. Anything that is out of the ordinary will ultimately get made ordinary over time, on average, in the stock market. The last line, I used to have this as my email tagline for years and years. The only perfect hedge is in a Japanese garden. So first off, I've been to Japanese gardens and they have really beautiful work. We actually have a Japanese garden right at the Chicago Botanic Garden, right next to where we live. Love it. I go there, they have a Japanese island, it's so beautiful. But that's not what this is talking about. This is talking about hedges, financial hedges. Remember early on we talked about the use of stock options and we said, well, if you own 1 million shares of a stock, you're going to want to have some hedge so that if those 1 million shares of stock go down by 14%, then the options that you hold go up by 14%, and that you're kept whole, that you hedged away your risk. If you're an airline, you want hedges against the price of jet fuel. If you're a labor-based company, you want hedges against the labor market. If you invest in real estate, you want hedges against the change in valuation for things like interest rates. And so let's use that one as an example. So I want to hedge away my interest rate risk or my credit score, credit quality risk. And so I buy that insurance. A perfect hedge says, well, the market crashes. And those options that I had are going to do great. They're going to be perfectly offsetting. But then, oh no, the company that sold me the hedge, the counterparty, goes bankrupt. Lehman Brothers goes bankrupt. AIG has trouble. Well, now what do I do? Now I bet all my money. I spent money on a hedge and I can't take it. Or I really thought that when General Motors went up, Ford went down. Or when Tesla went up, General Motors went down. But that hedge didn't work. I'm hedging one exchange against the other. Philadelphia Stock Exchange against the Chicago Stock Exchange. But at the end of the day, something doesn't work out. And so please don't ever assume that you can hedge away all of your risk. Because when markets get volatile, systematic things break. And so I come back to you with this point. The only perfect hedge is in a Japanese garden. And that was first said by Eugene Rothberg, who was the vice president and treasurer of the World Bank from 1968 to 1987. So I want to thank you for listening. So what we talked about some of the fundamental underlying beliefs and data and ideas that you have to have if you're going to fully understand what we're doing to optimize stock portfolios at Chicago Quantum. Again, thank you very much for watching. And if you want more information, please go to www.chicagoquantum.com. I'm going to flash up that website. So that you recognize it. So again, thank you very much. You take care now. Bye-bye.